Hi everyone, this is Finance Meets Real Estate. As you guys know, we meet here every Tuesday, 6:30 p.m. Eastern time. So we have amazing lecturers like Julia here today. Today we're having a lecture on market analysis. It's one of my personally favorite topics. And so Julia is going to talk about the world of multifamily market analysis. And so she leads, a multifamily investment firm called Untitled Capital, which has 1,400 units under management, or I'm sure the numbers are changing over time. And they focus on acquiring assets in Texas. And so in her past, Julia had a career in finance at various firms, including hedge funds like Schutz Asset Management, Concordia Advisors, Bulwark, Bay, as well as BNP Paribas, Credit Suisse. So she holds bachelor's in entrepreneurship from State University of Management in Moscow and MBA in finance from NYU Leonard Stern School of Business. She's also a chartered financial analyst. Okay, so with that, I'm going to pass it on to Julia. So if you guys have any questions, feel free to speak up. We're doing a presentation, like around 45 minutes, maybe less. And then you guys can refer your questions. If you want to put your questions on the chat, feel free to do so. So with that, yeah, I'm going to pass it on to you, Julia.
Thank you. Thank you very much. And very honored to be here. Good evening. Just a couple of words to add to what Stefan said. Yes, I live in New York City. I've been here since 2001. Actually moved from Russia, from Moscow, to go to NYU. They accepted me for business program for an MBA. And then, yes, for a very long time, I was working in various finance firms, mostly investing in something called corporate distressed debt or junk bonds as well. And stressed and distressed loans and things like that. Yeah, I worked in hedge funds and also investment banks, and then decided that I guess I didn't want to have a boss anymore and was looking for something else to do. Spent several months trying to figure out how do I not have a corporate job but still have money? and real estate just found me. I didn't know anything about real estate really, but I kept asking people who didn't have a corporate job, what do you do? And a lot of them did do real estate. So I started actually with vacation rentals. I own a few Airbnbs, and I used to do it in the Poconos and Jersey City. Now Poconos only, but also I was introduced to the concept of multifamily investing, which I really liked. And when I understood the model, I decided that I should be doing that full time. So for the last 4.5 years, I'm full-time multifamily investor, both as an LP investor, but my last few deals, I'm a lead general partner. And yeah, today we're going to talk about a market analysis. So I personally think that market is probably sometimes more important than the deal itself, because even if you buy a beautiful property, but it's in a bad market, it's very hard to do well, even though, over the last 10 years, due to cap rate compression, it seemed like no matter where you buy, you're going to do well, but it's much harder to perform well in a bad market. And so for that reason, market analysis is very important, and that's what we are going to talk about today. So with that, I did prepare a brief presentation, and let me share it right now. Can you guys see my screen?
Yeah.
Perfect. So let's get into it. So this is a slide about me. We already discussed my background. So yeah, there are several factors that I look at, and everyone who analyzes any market is looking at, right? So the most important one is population growth. So you want to be in a market where population is growing, not declining, for obvious reasons. But in a market with population growth, where population growth is strong, you have high absorption rate, and prices of real estate tend to go up over time. Also, when markets are growing, they tend to be more liquid. So when it is time for you to sell, you tend to have more offers for your property. So a few things to say here. Number one, I personally I invest right now in Houston only, but we're also looking at other markets. But my philosophy, don't go into tiny, small markets. A, because they're illiquid, and B, it's hard to find good labor there, like general contractors or staff to work on your property. Sometimes it's not easy. In a large city or in a large metro, you have a lot of options. If you go to a tiny place, it could be a challenge, right? And so you're going to be limited in your options. So I think the minimum population for an area for me personally to care is 200,000 or more, right? And then population growth, and this is just approximate numbers. There's no true, maybe somebody is more scientific, I'm not, but typically, the smaller the area, the higher the growth you want to see over a period of, I'm looking at 15-year period right now, and you can find those numbers online for most of the cities. So if it's, let's say 250,000 to 1 million people, if I see 20% growth over 15 years, it's a strong number. And same, if it's 1 to 2 million people, 15%. If it's a large area, there are maybe 20 or 30 large cities in the United States, including several on the East Coast, right? New York, obviously, Boston. Then in Florida, there are quite a few. Jacksonville, Orlando, Tampa. In Texas, you have 4 big cities: Dallas, Houston, San Antonio, and Austin, right? So those cities are large as is already, and they're growing, but you cannot expect like 20% or 30% growth because they're already so big, right? So if it's 10% over the course of 10 years total, I'm happy. And then the population growth number is very easy to find. Usually if you just Google city name or city and MSA population, it's going to come up. And just as an example, I tried Detroit, and usually, this is from Google, and obviously they refer to some other source, and the numbers, they all are taken from census.gov website. Yeah, Google usually gives you the city itself. So, which would be smaller than surrounding areas. So for that, you would just Google, Detroit MSA or Tampa MSA, and that's going to be a bigger number. So, but the point is, in real estate, you really can make money anywhere, no matter what you do. The gazillion strategies, but so there are people in Detroit that are probably making a lot of money buying real estate, but I would not, right? And there are several places where declining population growth. So, and we buy large multifamily properties, 200, 300 units and over. I don't want to be in a place with a declining population growth. And some other strategies, you probably can make money if you're doing fix and flips, or if you're doing like Airbnb. I actually have friends who are doing Airbnb in Detroit because housing is so cheap. I think like during the financial crisis, you were able to buy houses for like $10,000 and then Airbnb them. But this is not what I do. And if we're talking about multifamily, I would not go to a place with a declining population. I would go to a place with increasing population, and there are enough of them in the country. Most of them are in the Sun Belt area, such as Florida, Texas, Carolinas, Georgia, Arizona, and so on. So the next one, very, very important one, equally important, if not more important, job growth. So you want states and places where people are moving, where jobs are moving and people are following the jobs, right? So, and right now, because we had 2 years of COVID, the numbers are distorted. But if you look at the Bureau of Labor Statistics website, they have a lot of data on annual growth, job growth. And before COVID, for a few years, it was like 1.5%. But then we had a huge drop during COVID. So the last 2 years, the recovery appears stronger, but it's not normalized, right? But typically it's around 1% a year. And it is projected to be 0.7% a year for the next 10 years. So if you see states with higher than that job growth, they're attractive, and they're the usual suspects. It's all the same states everyone is talking about. Yes, Texas, Florida always lead the charts, and then Tennessee, Georgia, North Carolina, Arizona. So all Sunbelt jobs are moving there just because those states are more business friendly. The cost of living is much cheaper, and the weather, a lot of people think it's better. Yes, it gets very hot in the summer, but at least you don't have to deal with leaking roofs and ice dammings in the winter. So, and the trend of population migration to the south is not new. It's been going on for I think 10, 15 years. It's probably not going to stop anytime soon, but it's job growth and population growth, right? And to find a job growth for your area, for your city, for example, or MSA, again, it's publicly available. I just go on the website, the Bureau of Labor Statistics, and then the number you are looking for is total non-farm payroll for your area. And also you can Google, and then if you are working with commercial brokers, they have a lot of data and they are willing to share the data. So you just ask them, and they're gonna, because they also subscribe to a lot of companies that provide analytics, such as CoStar and RealPage and so on, and they will be able to share the numbers with you. And I always ask if I need some statistical data, I ask brokers, and they just send it to me. So job diversity. So here the idea is that you don't want to be in a city where there's huge concentration of one industry, because the moment that industry starts to experience issues, real estate follows, because people lose jobs and people move, right? And Detroit is a good example. So because automotive companies surrounding Detroit, a lot of them were not doing well, and that did cause population decline eventually. And then I think Pittsburgh was very exposed to steel. They had population decline, and then there are some metros or cities that overexposed to oil. Oil is like 50 or 70%. So the moment oil declines, and oil is cyclical, right? It is going to continue to fluctuate. Today it's high. Eventually it won't be, and then it will come back. It's going to continue forever, in my opinion. But then when oil goes to next time to $30 per barrel, there are some cities which are going to suffer. Same goes for some cities have very large presence of military bases. So, and the issue with that could potentially come up is once the military personnel gets deployed, they all have clauses in their leases that allows them to get out of the lease without a penalty. So if they get deployed, a lot of them leave, and your apartment complex, if you invest in apartment complex, and they loses a lot of occupancy. So when I tour properties in an area with high military base presence, I always ask, what's percentage of tenants who are military, and same in Houston, Houston became much more diversified than it was 15 years ago, but still some locations do have high concentration of tenants that work for oil and gas industry. And in that case, I would be asking that question: how many of your tenants work in oil and gas, right? And how many of them are foreigners? Because there are a lot of contractors that come from other countries and work for large oil and gas corporations, but they get sent home when there is a recession. So you want to know that. And some industries are more stable than others, right? Education, if you have college nearby, or if you have a lot of medical centers and hospitals, those are stable businesses, and recession or not, they continue to perform usually, and they don't lose a lot of jobs. So you do want to see health, education, financial services, just regular banks, and so on. And then you can find this information as well on a publicly available website, government website. And usually this is, I don't even remember what city it is, but this is just an example. It's a copy paste from that website on the previous page. And you can see here on the third column, they give you percentage breakdown of all the industry line items that they have. So you can at least get some idea, how concentration is in your area. Then median household income is number 4, very, very, very important, because you can kind of judge how good an area is based on how much people are making, people who live there. And the lower the median household income is, the more issues you will have. Because, you should be looking at median, not average, because some areas have very, few individuals who are very, very high earners, and they will skew the numbers, right? So it's industry practice to usually look, we look at both, but I pay more attention to median household income rather than average. So in my, opinion, the lowest that I personally would go is 40,000 for median household income. And right now, I don't even go that low. Right now, I want to see median household income more than 70,000, let's say, within 1 mile radius. And there is high correlation with delinquency. So the lower the median household income is, the more tenants you're going to have who are going to be not able to pay at some point, and they going to be defaulting on the lease. And it means that you won't be able to collect, and you need to evict them. And in some states, it's relatively easy. And in some states like New York, as probably you all heard stories, sometimes it takes a year or longer to evict someone. So it could become like operational nightmare. And then there is also high correlation to crime. So if it's a very low median household income area, chances are the crime is very high, and it's not good for your property either, because you're going to have problems, right? You're going to have break-ins, you're going to have car theft, you're going to have assaults, you're going to have police at your property very often. You could have murders, which is not good. So it's not to say you can have a murder in a very rich area, but statistically, it's more likely that crime will be higher if median household income is lower, right? And one of the exceptions that I saw, that college towns, they can have very low median household income because it's students who live there and they don't work, right? They don't have jobs, and their parents are usually paying for their college expenses, or in a lot of cases, that's the case. So it could be, if it is a student town, it could be that the numbers are skewed because of that, because a lot of young people who live there, they just don't have jobs yet, right? And you can find this information on City Data. City Data has a lot of very, very good information for free. And another website which I use sometimes is justicemap.org. Also, it's not pretty, it's not very well designed, but it does the job, and you can pull median household income and average household income and some other data from those sites, right? And if you are working with the commercial real estate broker, they have access to more data. Usually all of them have access to CoStar reports, and they can send you that as well. So this is just an example. This is a copy paste from the offering memorandum for a property I analyzed probably 2 or 3 years ago, but this is just to show that brokers sometimes, I don't want to say misrepresent, but they try to make the situation look better than actually is. So they're saying, okay, let's look at the median household income with the 10-minute drive and 20-minute drive and 30-minute drive. And the issue with that 20 minutes, it could be another town. It's not representative of your area at all. Same for 10 minutes. We'll, even in New York City, you see that, right? There's Upper West Side, and then it's completely different if you go to Harlem, right? So you should be looking at 1 mile median household income. 10 minutes, 20 minutes, and half an hour drive is completely irrelevant to your area. It's just something to be mindful of. Just remember that you really care about 1 mile radius the most. What's going on in that little like zip code where you're looking at, because it's true. Location is very true, and locations change. It could be very close, but one side of the road is amazing, and on the opposite side of the road, it's very close. It could be 5-minute walk, but it's completely different, and it's not a good area, right? With high crime and a lot of issues. So then median contract rent and how much people are paying for rent. So the majority of Class B and C tenants, they typically, what we see in different cities across, excluding New York, Boston, and San Francisco and LA, but all other cities like in the South, usually you're going to see 700 to 1300 in rents, what people pay. If you see something below 600, I typically just pass. Because there are some expenses that are fixed. Your property taxes are fixed, not fixed, they're changing, but it's non-controllable expense. You cannot do anything about it. So then insurance is also, it varies state by state, but it's always going up. And payroll also varies, but usually it's say 12 to 1500 per door. For a larger property, right? So if you have rents below 600, it's just very difficult to make money and to make the numbers work. And if you're coming in and say, oh, I'm going to increase rents, they're below market. If you start pushing rents by $200 on $600 rent, you're going to have a lot of people who going to leave, right? Because they won't be able to afford it. The reason they leave there is because it is 600. So I try to just not go in areas where rents are so low, because there are many places where rents are higher. I don't see a reason to, I don't want to be a hero and look for something esoteric, even though I know people who do that, and I'm sure some of them are very successful. Just not the game that I want to play. And again, this data you can find on citydata.com, which I highly recommend. They have a lot of data available for free, and that's very easy to navigate. So the next one is a median house or condo value. So when you're looking at apartment complex, so I buy apartment complexes, right? And multifamily business. So we look we prefer to have our properties in areas where median house values are high or higher or growing. And the reason for that is usually a certain percentage of your tenants, they leave every year due to, there's a turnover, so-called turnover, right? And on average, this number, this is average, you can see higher or lower, but on average, 50% of your tenants, they're gonna leave every year. So, and why they leave, there are several reasons, but one of the most common reasons, they're buying a new house, right? And they want more space, so they're moving out. But very often they like the area and they want to stay in the same area or in the same city. So if prices of real estate are very high, it makes it very difficult for them to save enough money for the down payment. So they're less likely to move, right? They just can't afford to buy a house. And as you know, I feel for them as a person, but as an apartment investor, I like that. You know, I want them to stay as long as possible and live at my property, right? And New York City, for example, or Jersey City, I think, you know, there's statistics available publicly. I think New York City is like 80% renters, just because real estate is so expensive. People typically don't buy. I'm a renter myself, and I overpay, but I prefer to live in an apartment complex because I don't want to be responsible for any maintenance. It is much easier to invest in real estate, rental real estate, in areas where it's harder for them to buy their own house. So, and we look at price to rent ratio, and the higher it is, the better. So ideally it's over 15 times. And also you can find it just by Googling, or City Data has it, Zillow of course has it. In San Francisco, as an example, this ratio is 52 times. So I think average house value is like 1.2 million. New York is actually lower than San Francisco. I think the site that I looked at today is at about 700,000 for average median house value. And Detroit is easy, right? In Detroit, you can, you know, why rent, right? You can just buy it, and it's, the housing is so cheap. And yeah, and you can find this data on the websites as well. Unemployment rate, also self-explanatory. You want to be in an area where people have jobs, right? Because the idea is, if they have jobs, they can pay your rent. If they lose a job, a lot of, you know, a lot of people don't have enough savings. I forget where I read it, but I read it every week. There is an article about that, that average person in the country has like $450 saved, something like that. So they are, a lot of renters are dependent on a paycheck to pay the rent. So you want reasonable, you will always have some unemployment, but you want this number to be reasonable. So if it is class B real estate, we say it should be same as the city average. And if it's class C, slightly rougher area, you're probably going to see higher unemployment rate, but we don't want it to be too high. So we say maybe 2% higher than the city average. So yes, unemployment rate, you can find it on, this is city data, right? This is copy paste from some zip code that I found in Atlanta. And you can see unemployment is 28.6%, which is very high, right? So I probably would not, if I see property offered for sale in an area like that, you know, there are already two things that I don't like: low rent and high unemployment and high poverty level. So I would, you know, very often I pass just because of the area. I don't even look at the underwriting or the property. I don't care. If it's in a bad area, it's a pass. So this is my actually, first step of analysis. Area has to be a check mark first, and then I continue to the property itself. So poverty level related, and it's available on the same chart as you can see here. So, and the same idea. The lower the poverty level is, the better is your tenant demographics, the lower the delinquency rate, and the more people who are actually paying tenants, right? So, and I don't, usually you can tell just by looking at median household income and house value, like other metrics. So it's very rare when I'm going to pull out poverty level specifically, but I do pay attention to it. So ideally it would be lower than 15%. If it's over 20%, I just move on. And again, this data is available on citydata.com. And then crime. On crime, self-explanatory. Very high correlation to delinquency, and then it's very hard to manage when there's high crime rates, and it becomes, instead of managing the property, you are managing the tenants and the situations that are happening on site, right? And we had a property like that when we had frequent police visits and gunshots very frequently, and theft, assault, this and that, and it just very low return on invested brain damage, as they say. So it's a lot of work, but it's not the work that is fun, or you're not very well paid for it, right? So and that costs money, because if you have high crime rate, you're gonna need to install gates usually, and cameras, and usually you would try to get a police officer living on site, and you would give them a discount on rent. So it's also expensive. If you have, if you have gunshots, you have no choice but to hire a security company, and that's going to be expensive. If it's 7 days, if it's 24/7 and 7 days, you're gonna go bankrupt just paying security company. So you should be very mindful of that. And one of the easy ways to kind of get some idea, and we're talking about investing out of state. If you're investing nearby, you're gonna know the area more or less, or you can ask the broker, or people who live there, who you probably know. But if you're investing out of state, you need to have some tools that you could use to give you some sort of an idea. So City Data, again, they have a tool, they have a crime index, and they say, okay, the average is 270 in the US, and ideally your city will be below 500. And more importantly, it should be declining. If it was high, if it is declining, it's already very good, right? So it means that they are managing things well and taking things under control. And then if it's, right now, this presentation was made for more like multifamily large apartment complex investing. So when we analyze a property, usually I would Google just property name, city, and murder. And sometimes I did find murders on site. So A, it's good to know what's happening. B, when you're buying, it might be an issue with the lender, because lender will look at that, and they will find out about the murder, and they might not lend, right? There are some lenders, they say we don't lend, or they want to lend you much lower, at much lower LTV. So it is something that you should know, and you don't want to buy a property if it's in a hood, right, and there are gunshots every day. And then you could go to sheriff's office. I did a couple of times. It's time consuming, right? You have to go, stand in line, submit paperwork, but they have all the records when they came out to the property, and it's publicly available. But it could be a little, convoluted how you get it. You need to fill out forms, and then they mail it to you. Some offices don't have it electronically, so you have to wait several days to receive it in the mail, but it is very useful. It is very useful. And then there are websites where you can look up crime. I listed several. I use crimemapping.com, but I use all of them, to be honest. The only thing is they only show you, most of them, only 6 months worth of activity. But some cities, if you start, Houston, for example, they have a very detailed database of everything that happened at any address. So it's an Excel file, so you can just download it and then search I search by street name, right? But not all cities have it. But crimemapping.com, for example, or spotcrime.com, they'll give you a general idea. If you open it up and you see like 5 murders, it's clear, don't go there, right? Or it's assault, rape, don't go there. If you see thefts, they happen anywhere, right? Even in good areas every once in a while. So I'm not necessarily turned off by a couple of thefts, but if I see murder or gunshots, and a lot of them, usually it's a pass, but it's also most likely that area is going to have low median household income. So I'm going to pass on it just because of the income. But there is very high correlation. There is very high correlation. And then I think this is the last one in my presentation. If you do invest outside of your own state, try to go to landlord-friendly states, right? And it's not to say that you cannot make money in unfriendly, and I would consider New York very unfriendly. But at the same time, people make a lot of money in New York. So I'm not the one who would say, like, don't touch New York. If you know what you're doing and you have a strategy, you'll make money anywhere. But if you're investing in a larger properties, and what we do, we have outside investors and a lot of them, right? So I want to maximize our chances of delivering strong returns and minimize our chances of getting into trouble with the government officials or with regulations or rent control and things like that. So New York, I think none of our investors would ever consider, right? I myself, I would consider if I was investing on my own, but I don't want to invest other people's money in unfriendly states. So, and what I would consider friendly states as states where it's easy to do business generally, and when it's relatively easy to evict a non-paying tenant. That, the state takes a position that if you're not paying, you cannot stay at the property, you have to leave. And there are tools available to get people who are non-paying tenants out, even though it became much harder after COVID. But it's still, I think in Texas, for example, where we are, it's not perfect, and it's slower than it used to be before COVID. Unfortunately, but it's still reasonable. Maybe gonna take, because before it was like 3 weeks and they're out, right? It was quick. Now it could be 2 months, 3 months, or sometimes even longer. But as compared to some other states, I've here New York, New Jersey, it could be 12 months, right? Or California. California probably you can live there forever and not pay. Then yes, Texas is considered landlord friendly. Georgia, Florida, there's a trend, right? All of those Sunbelt states. And how to find out if the state is friendly or not. There is a lot of information available for free online, but also you can call up property managers in the area and ask them questions, how easy it is to manage, how regulated it is, how easy it is to evict people, and they're going to tell you because they're doing it every day. So yeah, this is one of the things I like about real estate, that information is widely available. All you need to do is just look for it and ask questions and you'll get it. There's nothing, too complicated about it. You just need to know what questions to ask. Yes, so to wrap up, yes, I have 2 meetups in New York as well, which I used to run before COVID, and I'm going to restart them again soon, in person and virtual. So one of them is called Apartment Investing Mastery, New York City, and another one is in Long Island. It's called Apartment Investors Meeting. So if you're interested, please join and please come, and we're gonna have a lot of topics to discuss, and I usually have guest speakers as well. And to add to market analysis, some of the things which are not in the presentation, but you can also gain a lot by just, if you go to the area and you're driving around, you're gonna be able to form an opinion pretty quickly. Is it a good area or a bad area, right? And if you go to a property and you see like dilapidated houses, and you see cars that are broken and not taken care of, it's probably not a very good area, right? But you see like caged air conditioners, it means that people are stealing them for copper, right? So that's your clue. And then what kind of stores are nearby? One rule of thumb that people have, if they see Starbucks within like 1 or 2 miles, it means that it is a good area, because Starbucks is a huge company and they do very serious research before they decide to open up a shop. And Starbucks is also a very expensive coffee for a regular person. So like $4 a cup. So they're not going to open it in an area where people cannot afford it. So people look for Starbucks. People look for, I know one person, he always tends to look at sushi restaurants. He thinks that if there is a sushi restaurant, that means it's a okay-ish or good area. But yes, there are some clues that you can, just see driving around and paying attention what's around, what kind of stores, what kind of retail, what kind of restaurants, what kind of cars, and how clean the place is, right? And how well taken care of. So with that, this is the end of my presentation for today, and let's open up for Q&A.
Great. Yeah, thanks, Julia. Lots of amazing tips there on picking a market. A question that we have on the chat actually by Scott Edward is, what returns cap rate are you targeting on multifamily deals right now?
Good question. So, it's a moving target, and at every 2-3 months it's being adjusted. So talking about returns, so we'll look at cash on cash and IRR, right? And we've been adjusting them down over the last couple of years. So in the past, we would target, and we underwrite to a 5-year hold. So in the past, we would target 8% cash on cash, and we paid 8% pref at least. And IRR would be like 17 to 20% a year. Right now, we are guiding our investors to 6 to 8% cash on cash and 15% IRR. And it also depends on the property, right? If it's a value add class B property, it could be potentially higher. But we are actually buying now class A, suburban class A. So I think expectations of investors are lower for class A core assets. So we still try to, always offer something around 15% or higher. But I think institutional investors will probably agree to 13, 14%, right? But we're not institutional. We are small investment firm. So our investors are retail smaller investors. And in terms of cap rates, depends again on where you go. In Texas and in Sunbelt in general, the cap rates have been below 4 in large cities. Again, if you go to smaller, 200,000 population place, the cap rates are going to be higher. But if you're going to large metro like Dallas, Houston, Atlanta, all investors are looking to buy there. So your cap rates, and there's a lot of capital chasing deals. So cap rates, the last deal we're buying right now, it's in the works. It's below 4%, and but cap rates, right now there's a lot of uncertainty in the market. What's going to happen? I personally believe that cap rates are not gonna move materially, but there is a short-term movement right now to, direction higher, right? Because people are nervous, then interest rates are going up. It's harder to get a loan on a property, so they are expanding a little bit, but also depends on the asset class. Right? We're buying Class A, so Class A large core properties. They are much more stable because the typical buyer for properties like that is an institutional buyer, and very frequently they're not highly levered. So for them, interest rates don't mean much, and 4% cap rate is acceptable. When we were looking in Austin 2-3 months ago, the cap rates there were already sub-3, like below 3%, right? If you go to Arizona, there were like 2%. But why? There's always the reason, right? Is it unreasonable? I don't know if it's unreasonable, because if you look at the rent growth in, let's say, Phoenix or Austin, it has been like double digits and 20% or higher, right? So you're buying at a low cap rate today, but if rent growth continues, can it continue forever at that rate? It cannot, but you don't have to have that. If it continues at a high pace for a year or two, your stabilized cap rate is already higher. So it's an interesting phenomenon, but that's a long answer to a brief question.
So the other question is just added to the same one. So what is the average price per door right now that you're paying in these B and C markets? Well, I guess you're in Houston only, and only Class A properties right now, right?
So I have friends in other markets, so I kind of have an idea, right? So B and C, B in Houston, for example, I think like 170, 180 per door right now. And it came up a lot. It goes up for years now. I know people were paying 20,000, 35,000 per door, so they cannot believe that now it's like 175. We bought the property, very good B class, very solid property. A year and a half ago, it was 113 per door, and now if we would be selling it, it's probably going to be 170 or higher. So that's B, C, depending on the property, but probably around 100,000 per door. And Class A, again, there's a lot of variability. So we are buying ours about 230 per door, but it is a very good area, a very good construction, and it's suburban assets, right? And investors, a lot of investors at least, still prefer suburban versus urban, at least in Houston, in Texas. But still, it depends on type of construction, right? I know someone who just bought high rise in Houston as well, Class A, so very good area, good construction, high rise. It was 360 per door, right? So, and it depends on how much people are paying in rent, right? It depends on property taxes. In Texas, property taxes are killing everyone. They're very high, and they get readjusted every year. So for that reason, prices are still, going up, but on a relative basis, if you compare it to let's say North Carolina or Georgia, they're still lower. I have friends who are paying for similar product that I'm buying in Houston. They're paying like 275, right? And the reason is their property tax is lower. So yeah, I would say taxes right now, if you are talking Class A, it's already over 200. Some of it is already over 300. Same goes for Arizona. Arizona is higher than anyone. I think lowest cap rates are in Phoenix. And if it's Georgia, North Carolina, yeah, Class B, yeah, I think Class B is over 200 now as well.
And so another question from Scott. And it's actually, Scott, if you want to, feel free to speak up as well. So it's like, how are the rates going up affecting your business?
Negatively affecting. Yeah. Well, it's harder to get a lender to lend at the level, LTV percentage that they used to before, right? Before it was very easy to get 80% LTV. Today, if you're lucky, you'll get 75%, right? And then there's a lot of uncertainty of how high interest rates are going to go. I think most of the people I talk to, and myself including, we have a view that it's not going to continue forever, because if you look at the history, typically the rate increase cycle goes for 2.5 years, and then rates start to decline. So the hope and belief is that in 2023, the rates are going to start to decline. But right now, there is a lot of uncertainty. A lot of my peers, including myself, we are taking on bridge loans, right? And when you have a bridge loan, typically bridge lender would ask you to buy interest rate cap, right, to hedge the interest rate exposure, and we are obligated to do so. But the caps are very, very expensive right now, to the point where a lot of people, including myself, I think they're overpriced. That if you're purchasing a cap today, you're gonna pay more than you would otherwise pay if you did nothing. You just reserved for it, right? So it creates a lot of uncertainty in the market. I don't feel that fundamentals of the business have changed at all, at least not right now, because what we see in our properties, we continue to see very strong rent growth and very strong lease trade outs. But yeah, high interest rates, they affect also the mood of the investors, right? The lenders are uncomfortable, right? They want to lend you less, and the spreads have widened. So the interest rates, the floating rate is higher, but also the spread they're adding to the floating rate is also higher, and which makes investors also shaky a little bit. But I think if you're looking to buy right now, I would definitely buy, because everyone is so nervous. What we hear is the number of buyers have decreased materially. Some brokers say 70 or 75% less bids or less LOIs that they're getting per property, and prices are also lower. Not always, but very frequently. It's now 2 months ago, 3 months ago, it was always above the ask, 2%, 5%, sometimes 10%. In our industry, they call this whisper price. So they will give you whisper price, and there was very high probability that the actual price that you're going to pay is going to be much higher than the whisper. Now, people coming in, the investors, they are submitting offers at prices below the whisper, and very frequently does trade below ask or whisper price. So for that reason, I have a deal I'm working on right now, so I don't have the bandwidth to focus on anything else until we close this one. But if I had capital and time, I would jump on it, and I would actually be, because you can submit any price to and see if it sticks, right? Because people who want to sell, they know what's going on, and some of them, they need to sell. They don't have the luxury of sitting and waiting when the dust settles. So they might be willing to accept low price. So I actually kind of enjoy watching what's happening, but at the same time, I have my own deal that I'm closing, which creates some challenges. But it's a very interesting time right now.
Mm-hmm. So you mentioned, Julia, so you have your own deal right now. So what kind of interest rate are you able to get? Or, I mean, perhaps you locked the rate a little bit before, or I don't know specifically the specific timing, but what kind of interest rate are you able to get right now?
Yeah, so a lot of my peers, it depends on where you know, we are not, we haven't signed the loan agreement yet, but we have a term sheet. So our term sheet is SOFR plus 335 basis points, so 335 percentage points. And it's a good rate. It's a very good rate. So we have a good lender.
What's SOFR right now, approximately? What is SOFR right now, approximately?
It's above 1, you know, 1.05 maybe.
Yeah, got it. But then when you just trying to understand like the connection to the like, I mean, the cash on cash return, right? Because it's cash on cash return is just cap rate to interest rate spread, and let's you have 4 times leverage and the spread is 2% and you get, let's say, 8% cash on cash, right?
Right.
That's kind of the approximate calculation. So how does that work in the current interest rate? Even in
you know, anyone who is buying right now, myself including, you have to believe that you will get rent growth, right? And your rent growth will get you to the cash on cash returns that you are projecting, and this is the only way, right? If you think that your rent growth, you know, in Houston, yeah, in one of our properties we will have 20% growth, right? I'm not projecting that. I'm not projecting that in the long term, but this is what it is today, right? And if I think it's gonna, and I don't need 20% to continue, but if I think that it's gonna probably be 7% for another year and then drop to 6%, already I'm good, you know, because the rent growth is a huge driver of your valuation.
Well, yeah, for evaluation as well, and to an extent also cash on cash is assisted, right? Of that,
of course.
By that, but then what do you think in terms of? Well, I agree with you. Like interest rates, the trend is supposed to be okay. The Fed hikes rates, right? Interest rates go up, and then it kind of plummets into a recession, right? That's kind of what happens after this. Yeah. So it's really it doesn't last too long. Now it's right. Then let's say current mortgage rates, they have reflected an expectation of rate hikes at the moment, but you know, it could be a little bit more. And I think there's like I looked at some of them. Well, it's the residential mortgage rates, right? But just as a highlight, some of the models for like where they're going to be through the end of the year. So okay, 5.5 like median rate now to get to like 6.25 maybe, right? Which is very high. But what do you think in terms of like, because if you get at some point, if your like cap rate interest rate spread goes too negative, it kind of the whole value add model disappears, right? Because if you think of Canada, for example, there is no typical like value add, you know, syndication deals with the pref that are offered. You know, they just kind of like to test for appreciation, and it's kind of a different. The business model itself that we've seen that's been incredibly profitable in the US has been part, you know, supported by that environment of, you know, fairly high cap rates. So, and cap rate interest rate spread, so to say. So where do you see, like, I don't know if you guys do like some kind of maybe like sensitivity. I know it doesn't have to be like super.
No, we do have usually sensitivity analysis.
Okay, something like that.
Rates. Yeah, and we feel, can cap rates go a little bit higher? They could, but I don't see them going dramatically higher, because we also know that there are a lot of investors chasing this particular asset class, right? And a lot of pension funds, institutional investors, and this capital is not going to go anywhere, right? Because Historically, multifamily is very resilient, and as compared to other asset classes, stocks, bonds, oil and gas, anything, it's less volatile and more stable and has performed exceptionally well. So the returns have come down, right? But they're still on a relative basis are very attractive. So in the past, anyone who invested, you could invest with your eyes closed, right? Over the last like 10 years, you made money. You didn't need to do anything, just buy anything anywhere and just sit in it and then wake up and sell, and you're going to be a hero. And now you have to be much more careful, and that's why we made the decision to buy in much better areas. We don't want to buy Cs anymore. Not to say that I'll never do it, but right now, no, we buy very good areas. This property we're buying right now, the household income is about 135,000. So high household income. It's a beautiful construction, very good demographics who live there. So, and then we're gonna focus on operations, trying to maximize income, add other income to it, and minimize expenses. So renegotiate all contracts. And I think 15% is still possible, especially in large Sunbelt states, right? Texas, Florida. I don't think people are going to stop moving to Florida, and then rents are going to collapse completely. Can it go down a little bit? I don't even think they're going to go down. I think the rate of growth the pace of growth is going to come down, because what we have seen over the last 2 years is unprecedented, right? My rent in my apartment complex went up 35%. And I took it because I looked around and everyone is doing the same. There's nothing that I could find that was better and cheaper, right? So this is unsustainable, but I still think my rent will go up, and everyone else's rent all over the country going to continue to go up over the next at least 18 months, but probably longer in the states where people are moving.
But if we do have a recession, then kind of not.
It's going to slow down. It's going to slow down. No, in the recession, but typically in most properties in a good area, you don't see, you might see concessions, but they don't last too long. Even during COVID, there was 0%. Usually it's flat growth. During COVID, you just don't raise rents at all, but it's only goes on for a few months, right? And once you see that the dust has settled, you start again, and then it eventually catches up. It could happen, right? Yes, a recession, could it happen? Yes, of course it could happen. Rent growth, will it slow down? It will slow down eventually. I cannot see how in Texas or Florida it can go from 15% to 0 or negative. Just because there are so many people moving, right, and looking for places to rent, and on a relative basis, it's still cheap, right? In my property, you can rent a huge 2-bedroom for $1,400 a month. So if people are moving to states with lower cost of living, for them, they're amazed of how affordable it is, especially if they're moving, right from California's, New York's, and Boston's.
So, so just like, and actually we're a bit over time, but thank you for kind of being generous with your time, actually. And so Julia, so with your, just like kind of your personal story, so when you transitioned initially, kind of got into multifamily, like you mentioned, like you had some vacation rentals and Airbnbs in like Poconos and Jersey City and places like that, right? Close to New York. So, which is where I am as well, like personally. So when you transitioned to multifamily investment, so what was your, how to say, like competitive advantage, or like what were you able to do in order to raise capital? Like what was your strategy? Because I know like many people, they do it either through their podcast, or perhaps they have really, it's much less common have really good SEO on their website. Extremely uncommon in the real estate industry, I would say. But let's say there are a few people I know who have been able to do it that route. And so what was like your advantage kind of contacts perhaps from the finance industry, from work before, or like what was your approach to that?
Well, I didn't have any advantage really, and it took me 3 years to start doing deals as a general partner. And yes, I did talk to a lot of my friends and former colleagues, and I told them what I was doing. And I didn't ask for money, but I was asking them, if I had a deal, would you care to invest, right? And when finally I did have a deal, some of them did invest. So I can raise some capital, but what I also realized in this business, it's a team sport, especially when you're starting out. So if you're new, and you want to do larger deals, and you do want to use other people's money, it's much easier if you partner up with other people who have been doing it before. And some of them, they specialize in capital. That's what they do. They either have their own, or they have an existing database and they can bring capital. But they, for example, don't want to do anything else, right? So I just, at some point, I said, okay, I need to kind of understand what is it that I want to do in multifamily. What is my role? What is my personal role? And then what can I offer to others to entice them to work with me, right? And then once I became clear what it was, and for me, it was underwriting, of course, because I come from finance. So underwriting I love, and it's easy for me. Then because I was full-time, I had time, and I could fly around and tour properties and, you know, make connections with brokers and property managers. And I could also asset manage. So once the property is purchased, somebody needs to manage the manager, and it's a combination of finance and accounting skills and also just business acumen. So I thought I could do that, and it could become tedious over time. So a lot of people do not like that part of the business. So I could offer that. I had some money, not a lot of money, but I had some money that I could offer for earnest money deposit, because when you're putting down hard money, typically people want to split that risk and not invest themselves in 100% of the earnest money deposit. So I said, okay, I have some money for that. I have some net worth, which we could use, because to qualify for a loan, you need to show net worth, right? And it's a net worth of a combined partnership group. And that was it. And I told them I cannot raise. I'm not going to come with a lot of capital. So somebody needs to raise, but I can do pretty much everything else. And this is how I started, because people wanted to partner with me for my underwriting skills and for my go-getter attitude, because I can, you know, go and find all deals, underwrite them, you know, submit all offers, and I always stay on top of the broker. So, and people like that, and you know, some people didn't want to fly, so I flew, I toured, and I've been, you know, it took me 3 years before I was able to get onto my first general partnership deal. But after that, once you start, it becomes much easier. You become much clearer on, you know, who is doing what and who you need to partner with, because you don't need to bring capital, right? There are people, for example, they say, I can do asset management and I can do investor relations, and they have a database, right? So for me, I don't particularly like raising money myself. So I just partner with people who can. Right? You don't have to do it on your own.
Yeah, that makes sense. So it's kind of like finding the deal, like underwriting the deal, doing good asset management in the deal.
Exactly. Yeah, because there are several functions. I think the most important ones are A, acquisitions, and B, capital, right? So yeah. I decided not to do both as I originally wanted, because I'm a little of a control freak. But I said, okay, if I had to pick one, I'm an acquisition person. And then let other people do the capital part.
Got it. And that makes sense. So if do you guys have any other questions before we wrap up for today? Okay, so thank you so much. It's been a pleasure to have you here, Julia, today. Like, lots of amazing.
Thank you very much.
And thanks for answering our questions as well. So with that, I'm gonna just wrap up for today. And thanks to everyone for joining us. Have a good night.
Good night. Thank you very much.